Hi, this is Alessio. Hope you're well. This will be a very important video because in this video I'm going to take a look at some important charts, for example this one and this one, and explain what they potentially mean for the major stock markets. And you're probably thinking, well, why the stock markets? Why not Bitcoin? Why aren't we looking at the chart of Bitcoin in this video? The answer is, guys, as I'm sure you know, what will happen to the major stock markets could have a major impact also on crypto and Bitcoin as well. So if you want to know what's going to happen to Bitcoin, you really need to pay attention to this chart here on the S&P and the major stock markets. So guys, we're going to dig into this chart on the S&P and also this chart here and also this chart you're seeing here, what this potentially means, and also what this signal means here as well. All of these data will have important impacts for the major markets. Plus also, guys, in this video we'll talk about the kiss of death example again. So we'll talk about the kiss of death signal, give you an update on this. All right, guys, join me. All right, guys, welcome back. Now, before we talk about the kiss of death, I want to first of all do a very quick review or recap of what's been happening here on the major markets. Now, as I'm sure you know, this particular rally that we had here from the June lows hit some important key levels here on the stock market. In fact, this particular chart on the daily time frame of the S&P, notice it hit the 200 daily moving average here with overbought conditions, which I'll talk about in a few minutes, and it got rejected from this level. In fact, the same thing happened also on the monthly time frame. This is the monthly chart of the S&P, and notice we had a rally back to the 21 EMA. It went a bit higher, of course, but then it got rejected and fell below the 21 monthly EMA here. So you could say buyers pushed the stock market back up to the 21 EMA, and at this point, sellers, a bit like that character Paulie from The Sopranos, they jumped in and they said, oh, wait a second here.
Get the out of here.
Exactly. And they pushed it back down again. Same thing happened, as you can see here on the daily chart from the 200 moving average here as well. By the way, if you've been watching our member videos, then you know that as the market was rallying higher here into resistance, we actually had been anticipating and expecting a pullback in the major markets. In fact, here's a clip for you. The market is quite a bit overbought on the short-term RSI and the long-term RSI are now both overbought. And also the fact that we are getting quite a lot of over bullish sentiment with approaching resistance. So this is a level where we potentially may see a pullback. Any pullbacks could actually test probably in this region, 4176 to 4100 to a low of perhaps 4030. Now, could it go lower than that? Yes, of course. If the S&P does not hold this region of 4030 to 4000 region here, then it may extend lower to the next support, the 61.8% golden ratio retracement near 3952. All right, guys, thank you for watching that. So as you can see here, the stock market has now pulled back to just slightly below the levels I was expecting for a pullback, but it's actually come back. You can see it's come back now to test this key support level here, just near this July low, and also this rising trend line, this magenta line you see here. This, you can see, is an important trend line support by connecting the lows of June to the lows of July. You can see we've come now and tested that level and held. You can see we're just holding above that trend line support. So that trend line could be an important support level for the S&P, I think, in the next coming days and weeks. Now, let's have a look at the monthly chart. Now, as you can see here on the monthly chart, as I explained to you in my video some weeks ago about the potential kiss of death signal, by the way, the kiss of death signal has not yet triggered on the S&P. But before we talk about that, let me just quickly recap what the kiss of death signal even is. Now, if you haven't seen the video on the kiss of death, I've gone into it in much more detail in that video, so go ahead and watch it if you haven't seen it. I'll put the link for you in the description at the end of this video. But the bottom line is, guys, just to give you a very quick recap and review of what the kiss of death signal is, which by the way is explained for you quite simply here in this in these rules. There's a three-step rule system here. But essentially all it is when the stock market from an all-time high, so from all-time highs, it drops back below the 21 monthly EMA, then if it pulls back to the 21 EMA, and then if it rolls over and then takes out the prior low before the bounce, okay, as you can see, if it takes out the prior low and falls below it, then it triggers what's called the kiss of death signal. Let me give you an example, because I think by looking at some examples, it will make much more sense. So look what happened in 2008. After making all-time highs in 2007, it then dropped and closed below the 21 monthly EMA, okay, and then it pulled back. You can see it pulled back to the 21 monthly EMA here, went slightly higher above it, and then it got rejected. It got rejected and went below the lows it made. That's very important because confirmation and a trigger only comes after it falls below the lows that were made before the bounce back to the 21 monthly MA. Okay, and when it took out the lows that were made here, then it triggers and confirms the kiss of death signal. And you can see what happened afterwards. Then the stock market plunged and crashed by nearly 50% from its highs. Okay, it went significantly lower in a much more dramatic bear market. Here's an example for you from the year 2000, 2001. You probably remember this is the dot-com crash. Now, in that year, in the year 2000, look what happened. After making all-time highs in the year 2000, it then dropped below the 21 monthly MA, closed below it, okay, then pulled back to the 21 monthly MA here, and then it got rejected, okay, and then fell below the lows that was made. That's very important because, again, confirmation only comes by triggering and taking out the low. And then, of course, as we know, the rest is history. It then dropped by 50% from its highs all the way down to the year 2000, 2003, okay? What about the year 2020? Now, in the year 2020, at the start of the COVID crisis, look what happened. The stock market crashed by 34% from its all-time highs. Then it pulled back to the 21 monthly MA, but there was no kiss of death. Why? Because the price did not get rejected, and it did not take out the lows. And therefore, because it did not take out the lows that was made here, therefore there was no kiss of death. Now here's an example from 1969. In that year, again, after making all-time highs, it dropped below the 21 monthly MA here, closed below it, then pulled back. So you can see it dropped here, pulled back to the 21 monthly MA here, got rejected, and then triggered. You can see here, it then triggered the kiss of death by taking out the prior lows and continued to drop further lower, as you can see here, in a bear market. Now, here's the most famous example from the 1929 to 1932 Wall Street crash, the most famous crash in history. And you can see what happened in that year. After making all-time highs, it then, see the Dow dropped to the 21 monthly MA here, then pulled back to the 21 monthly MA here, and then got rejected, and then took out the prior low, and then essentially triggered a much more long-term bear market. Now, if you were to look at the chart, the current chart of the stock market here on the S&P, the monthly chart, you can see that while we have two of the steps completed here, so for example, on the S&P chart on the monthly time frame, notice we had all-time highs, then we dropped and closed below the 21 monthly MA here, the blue line on my chart, then it pulled back, it rallied back to the 21 monthly MA. It seems to have got rejected from it. You can see it went a bit higher and then it got rejected from it. But here's the important point. Is there a kiss of death at the moment? The answer is no. There is at present no kiss of death. Why? Remember, as I'm sure you know, confirmation only comes, a trigger only comes if we take out the lows that was made, the lows that were made before the bounce. In other words, the lows of June, just near 3,636. Those lows have not been taken out yet. Okay, and we don't know if they will be taken out. All right, guys. So it's a matter of just being patient to see if we get confirmation or not. But let me just mention this. You're probably thinking, well, is there any evidence out there? Is there any chart or maybe some kind of evidence for a potential kiss of death scenario? Yes, guys, there is. And this, I believe, is by far probably the strongest piece of evidence for a potential kiss of death scenario. So this is what's called, by the way, this chart is courtesy of Jason Gephardt of Sentiment Trader. It's what's called the bear market probability model and macro index spread. And the most simple way to understand this chart is very simply like this. High readings on this model are bearish for stocks, whereas low readings are considered bullish for stocks. So let's have a look at this chart here. Notice that whenever this spread gets over, so notice we had, by the way, we notice we had a recent signal in May of this year, and in September of last year. By the way, in September of last year, I made a video for you probably remember, talking about this very signal. Here's a clip.
This data from Jason, which is flashing at bear market probabilities rising plus deteriorating market conditions, this is giving us a huge warning that, yeah, things are not looking good, and that potentially we are heading towards a major recession or potentially depression and a bear market likely in the next few years.
But look what happened every single time this triggered. In the year 2007, 2008, when this signal triggered, well, we know what happened that year. We had the major bear market and recession. In fact, whenever this signal has occurred in the past, it has been a high probability of a major recession and a bear market. Before that was the year 2000, as we know, in the year 2000, that ended up being the dot-com bubble and crash. And as we know, before that was the year 1990. That also ended up being a recession and also a major drop in the market. And of course, in the year 1973, the famous crash and bear market of the 1970s, and also in the year 1969, which, as you probably saw a few minutes ago, that was also a major bear market as well. So every time this particular signal is flashed and triggered, it has been a high probability, not a certainty, but a high probability of a recession and a bear market. And as you can see here, the most recent signals were in September of last year and also in May of this year. So the question is, will this result in a much more prolonged bear market and recession like the previous examples? Well, it's a possibility and a probability. So keeping it simple, this particular data you're seeing here does support the potential for a kiss of death signal on the stock markets. But remember, we still need confirmation by taking out the prior lows. That has not yet happened. Now, you're probably thinking, well, is there any data out there that maybe supports the opposite point of view? Is there any data out there that supports a bull market instead of a bear market? The answer is yes. And this is the data I want to talk to you about. In fact, this is by far the most bullish chart for the stock market. Now, you're probably thinking, well, why am I showing you something that's positive and bullish for the stock market? The answer, as I'm sure you know, is to avoid confirmation bias. As I'm sure you know, the most deadly mistake which any trader or analyst can make is to just look at data that supports their view, which is confirmation bias. Confirmation bias is when you believe what you want to believe. But that's not what I want to do here in this video. I don't want to give you just one set of facts to support one perspective. I want to give you another set of facts which supports a different perspective. And that is to avoid the danger of confirmation bias. So I want to talk to you about this chart, which is basically market breadth. And in case you don't know what market breadth is, imagine, for example, you take your car to a mechanic. Now, what does a mechanic do? A mechanic opens the hood of your car, or the bonnet of your car if you're in the UK, and they inspect the health of your car. Is the engine working okay? Are all the different parts of the car interior working properly as they should? So essentially that's what we're doing here. Market breadth is essentially looking underneath the hood of the stock market and seeing if it's healthy or unhealthy. And look at this over here, guys. Just recently, this chart showed a very bullish signal. This is in August. Look what happened here. This particular reading went from oversold conditions to overbought conditions of over 90%. As you can see, very quickly, it went over 90%. Now you're probably wondering, so what? Well, every time this has happened in the past, it's been a very bullish and a positive sign for the stock market in the long term. In other words, for the next 6 to 12 months. For example, this is what happened in the year 2020. It dropped below 20%. And then it quickly recovered and went back above 90%. That was in May of 2020. And we know what happened afterwards. And the stock market rallied significantly higher, as I'm sure you probably remember, from 2020 all the way to the end of 2021. Here's an example for you from the year 2003, 2009, 2010. Look at this. After the dot-com crash of the year 2000, 2001, 2002, look at this. We had oversold conditions here in 2002. Then it went above 90%. So we had an overbought reading here. And that signaled the end of the previous dot-com crash and the bear market, and it signaled the beginning of a new bull market. Same thing happened in the year 2009. Look at this. In 2008, we had an oversold reading here. We had 2 oversold readings, but then it went quickly above overbought. And you can see this every time. Whenever it goes above 90%, that signals the end of the previous bear market and signals the beginning of the new bull market. And we know what happened afterwards, by the way. From 2009 onwards, the market rallied in a significantly bullish uptrend. So this data must not be ignored. It's by far the most bullish signal for the stock market, especially if it gets confirmed. And by the way, if you'd like to know what this data actually is, what this market breadth signal is, make sure you watch my members video. In tomorrow's members video, I'll discuss with you one more time and explain to you what this particular data chart is. And again, remember, the reason I'm showing you this chart is to avoid confirmation bias, which, as I'm sure you know, is a very dangerous mistake. So the question is this: what does it say about the stock market? Let's go on this particular chart over here. Quite simply, it works something like this. Notice I put 2 lines on my chart, one green, one red. Essentially, it's very simple. If the market were able to get above the green line, so if the market were able to rally and get above this green line you're seeing here at 4305, if we saw a close on the S&P above 4,305, which by the way is the daily closing highs on the S&P in August, then it would confirm a bull market continuation. So in other words, if the S&P was able to get above and close above 4,305, then it would reconfirm a bull market continuation. However, if the stock market instead takes out the lows that were made back in June, this red line you see on my chart, at 3,636, then if that happens, that would trigger a kiss of death signal, essentially would confirm a kiss of death signal, and could result in a much more prolonged and long-term bear market, potentially like the year 2008 and also the year 2000, 2001 as well. All right, guys, so it'll be very dangerous for the stock market, actually, if it takes out this low that was made here just near the June lows here, because that would confirm a kiss of death signal. So in this video, we have looked at one piece of evidence which supports the kiss of death scenario and one piece of evidence which supports the bullish scenario. The question now becomes, which path will the stock market choose? And guys, keeping it simple, I think the best and most safest approach is this: just being patient, and let's wait for the market to decide. Because as I'm sure you know, the months of September and October are very volatile and unpredictable months. So I think the best thing we can do, the safest approach at the moment, is just being patient, and let's see what the market will choose. Will it choose the bullish scenario here by taking out the green level at this level you're seeing here, or will it take out the red level to trigger the kiss of death? It is as simple as that. There's not much else we can do. In the words of Tony Soprano,
we don't know.
exactly. What are you going to do? Except have patience and wait for confirmation from the stock market. All right, guys. Now, in tomorrow's members video, so make sure you watch tomorrow's members video, because I'm going to give you the probabilities. Because so far, you're probably thinking the probabilities of each scenario are 50-50, but actually in tomorrow's members video, we'll talk about the probabilities in more detail, and also we'll talk about the potential wave counts, the Elliott wave counts, and we'll go on to the chart of Bitcoin as well. All right, guys. And if you're not a member, you can join and become a member on that link you see right there. Thank you very much indeed. I look forward to seeing the next video update. Bye for now.